So, hi, this is CEO Unkar Sabani. Good evening to all of you. I welcome all of you to the today's webinar conducted by the Professional Forum. And today we have CA Kunal Sardeshpande with us. India has become really inevitable part of professional life, and understanding it completely has become really important nowadays. And Ind AS 116 is also one of them, which is having a prime importance considering its first time application in FY 1920. So, throw some light over the same. We have with us CA Kunal Sardeshpande. Let me introduce. He's a very close friend of mine. He has completed diploma in IFRS in June 19 and had done articleship in Chandorkar and Limay Chartered Accountants from Pune, and currently employed at BK Khari and Company Chartered Accountants since October 2018. Actively involved in the transition to Ind AS 116 process for the listed unlisted companies to which Ind AS is applicable during the current employment. And apart from CA field, he is also a theater activist and is closely connected with the theater groups in Pune. So that's uh, all about the today's session. And I would like to uh, get the session started, Mr. Kunal Deshpande. Sir Deshpande, I'm sorry.
Yeah, thank you, Onkar. First of all, thank you, Professional Forum, for creating such a wonderful platform for emerging professionals like us. For this current webinar, I have chose Index 116 as a topic, since it is a very much relevant topic, as Onkar has rightly said, that it is applicable for the first time for financial year 1920. So, and this is also relevant for professionals also, and CA final students also. So if you know any of your friends are attempting for CA final exams, please do share the link to them also, so that they'll be able to get benefit out of it. Okay, so we'll start with Index 116 session now. So I'll just run you through what contents I am going to discuss in further slides. So first one is Index 116 overview. I'll just give you a brief introduction what exactly Index 116 talks about. Then what are the prerequisites of lease? Then a typical discussion of finance lease versus operating lease. Then Index 116 has given certain indicators to decide whether a lease is a finance lease. Then I'll be discussing accounting by lessor and lessee and their recognition and subsequent measurement. I'll have a case study for lessee accounting, then its impact on the financials of lessee. Then at the end of my session, I'll give you a snapshot of Index 116 in a table. Then since Index 116 is applicable from 1st April 2019, so how transitional provisions are drafted and how companies will have to get into it, and how what types of what steps companies should do in transiting from Index 17 to Index 116. I'll run you through that slide. Then at the end of my session, I'll go through the things to be kept in mind by companies and auditors. So let's move ahead. Uh, as I discussed, the initial date of application for Index 116 is 1st April 2019. So what peculiar change it has made, that it has eliminated accounting difference between an operating lease and a finance lease for the lessee. Uh, so in Index 17, the accounting treatment for lessee it was different, but now in Index 116, the accounting treatment is completely different. So lessees with operating leases will have a major impact on in their books. Then for lessor, the accounting and classification is done based on existing operating and finance lease model. So there is no difference for lessors in terms of accounting and classification. Before we discuss the prerequisites of lease, I just want to create a situation. So based on that situation, we'll be able to unfold each and every technical term of this Index 116. So let us take an example. There are two companies. One is X Limited, one is Y Limited, and X Limited is willing to set up a corporate office in the premises of Y Limited. They enter into an agreement, and in that agreement, there are typical covenants such as the lease rent for a period of 5 years. Like the lease term will be for a period of 5 years. The lease rent per annum will be rupees 10 lakhs per annum. Then all the rights during the lease term will be of that premise will be exchanged from lessor to lessee. That is from Y Limited to X Limited. So if we just recollect what the covenants are, which have been mentioned in the agreement, that is there is a premise, that is identified underlying asset. Then second one is the rights for to use that asset have been shifted or have been exchanged by Y Limited to X Limited. So there is a right to use the asset in for X Limited. Then there is an exchange of consideration of rupees 10 lakhs per annum. And we also take the fair value of that premise as 40 lakhs, because that will have an impact in further slides. I'll of course tell you where it will have an impact. So in a particular lease contract, there has to be identified underlying asset. Then there should be a right to use that asset and exchange of consideration. If all these three conditions are satisfied, then a particular contract can be regarded as a lease contract. So in our scenario, the contract will be termed as a lease contract. We have not gone into that detail whether this contract is a finance lease or operating lease. That will be covering in further slides. So, IND AS 116 has defined finance lease and operating lease in a very much effective manner, but in a technical language. So, the finance lease is a lease which transfers substantially all the risks and rewards which are incidental to ownership of an underlying asset from the lessor to lessee. And lessee obtains all the economic benefits. So, what do I mean by economic benefits? So, let's say, for example, in our case, if X Limited uh, sublease certain area of that premise to, let's say, A Limited, and if it earns, let's say, rupees 1 lakh per annum as a rent, then that is what economic benefit is. So, if X Limited is earning rupees 1 lakh, then lessee, that is X Limited, has obtained all economic benefits. Then next one is lessee has the right to direct the use. So how to use that premise, what type of furniture X Limited will install. So all the rights of that premise will be in the hands of X Limited. So then the definition of operating lease is pretty much simple. Any lease which other than finance lease is an operating lease. Of course, these definitions are pretty much technical, but IND AS 116 has prescribed certain indicators. Of course, that list is not exhaustive, so those will be applicable on case by case basis. But few of them I have covered here. Okay, so the first indicator is the lease transfers ownership of an underlying asset to the lessee by the end of lease term. So that is not the case right now with our situation. But if we consider that if Y Limited is giving a right, or at the end of fifth year, the ownership will get automatically transferred to X Limited, then we can call it as a finance lease. Uh, if the lessee has the option to purchase the underlying asset at the inception date, so if Y Limited is giving an option to X Limited at the end of fifth year to purchase or not, so considering its probability of accepting that option, we can say that, okay, so this is a finance lease or this is an operating lease. Then the lease term is for a major part of economic life of the underlying asset, even if the title is not transferred. Say, for example, if I'm asking a lessor to prepare a plant and or manufacture a plant and machinery for me, and let's say economic life for that machinery is, let's say, 5 years, and if I am entering into lease agreement with that lessor for a period of 4 years, so I am holding that asset for major part of its economic life. So that means that after the end of the lease period, that asset will not have that much significant value. So it will be assumed that this is finance lease. Then next one is, at the inception date, the present value of the lease payments amounts to at least substantially all of the fair value of the underlying asset. So I would like to refer you to the fair value which I had given you in the example, that is fair value of that premise will be 40 lakh rupees. So if we roughly calculate the present value of minimum lease payments, how to calculate, of course, I'll be discussing in further slides. But if we just calculate it, it will land up roughly between 30 to 40 lakhs, 37 lakhs to 40 lakhs. Pardon. So considering that my present value of my minimum lease payments is more or less in the same line with the fair value. So this indicator is getting triggered in our situation. So now we can say that X Limited and Y Limited have entered into a finance lease. Then the underlying asset is of such a specialized nature that only the lessee can use it without further modification. Okay, let's say for example, if I am asking a lessor that manufacture a specialized nature machinery, which only I'll be able to use it in my own manufacturing process, and nobody else can use it, then it is as good as I am asking lessor to create an asset or to manufacture an asset which only I'll be able to use it. So nobody else can use it, so that's why we can call it as a finance lease. Then after cancellation by lessee, losses to the lessor are to be borne by lessee. So if in case of X Limited and Y Limited, if or let's say in my machinery case, if at the end of my lease term or just before that, if I go into cancellation, then some kind of dismantling cost or some kind of overhauling cost are required to be incurred. And if I am ready to bear that cost, then it is as good as I am owning that asset and I am destroying that asset, and I am bearing that cost. So it is as good as my own asset. So it is a finance lease. So what do I mean by finance lease? Is uh, there is no requirement of paying the cost of the asset upfront in it entirely, but lessor is giving me facility to pay it over the lease period. Okay, so now we'll be discussing accounting treatment by the lessor. Uh, so there will be a classification of finance lease and operating lease in lessor's books. If it is a finance lease, then lessor has to recognize the receivable asset at an amount equal to the net investment in the lease and give credit effect to the PP, that is property, plant, and equipment. So net investment in the net investment in the lease will be present value of the lease payments, any residual guaranteed value. So this is what net investment is. Then lessor has to unwind the receivable asset, and create or recognize the income, finance income over the period of lease term. How to do that? Of course, I'll be covering in my example. Then, if it is an operating lease, so here there is a straightforward treatment. So, for operating lease, you will have to recognize a property, plant, and equipment asset. You will have to depreciate it over a period of lease term, or over the period of useful life of that asset. Then you will have to recognize the income of lease on a straight line basis. So now the accounting treatment by the lessee. So there are a few prerequisites which specifically have been prescribed by IND AS 116. So first one is exclusions. So two type of leases have been excluded by IND AS 116. in categorizing in finance lease. So first one is short-term leases, that is the leases which is having a period of less than 12 months. Then the leases which is having underlying asset with of low value. So what do I mean by as underlying asset with the low value? Let's say for the companies like Reliance, if they enter into a lease agreement with the lessor to have a motor car on lease. So for a company like Reliance and comparing their asset base with the fair value of motor car, of course it will be a very insignificant value. So they can have an option to treat it as an operating lease. Then the next one is lease term. So in lease term, there are three periods. First one is regular lease period, then the extended lease period, that is if the option is given to lessee and probability of choosing that option by lessee is pretty much certain, then that period will also have to be factored into your lease working. Then mandatory cancellation period. So for any lease contract, there is a typical clause in the lease agreement that okay, so for 12 months there is a mandatory cancellation period. So it's like a notice period. So by giving notice after 12 months, by giving notice before 12 months and after completing of those 12 months, you'll be able to conclude the contract. Then next one is interest rate. So for unwinding activity, lessee has to have a proper interest rate, which normally will be incremental borrowing rate. Let's say if the company is a debt-owned company, the company can use their own debt interest rate. But if it is a debt-free company, then benchmarking has to be done for the interest rate. Then lease components is a peculiar thing which Ind AS 116 talks about. You will have to identify all the lease components and you will have to recognize them separately. So let's say in our example, if Y Limited is additionally giving a facility of car parking of let's say 10,000 per month. So there are two separate identified assets. First one is the premise and the second one is facility of car park. So accordingly, the lessee has to bifurcate his lease working into two components. One is car parking and one is premise. So how do accounting will take place? So that I'll be covering in this slide. So lessee has to initially recognize assets and liabilities for all leases for a term of more than 12 months unless the underlying asset is of low value. So both the exclusions have been covered here. So lessee has to recognize a right of use asset representing its right to use the underlying leased asset and a lease liability which represents its obligation to make lease payments, and lessee has to classify both of them into PP and non-current or current financial liabilities. And both right of use assets and the lease liability, lessee has to measure it at amortized cost. So Ind AS 109 talks about recognition and measurement of financial instruments. So it gives three type of methods. First one is measured at amortized cost. Second one is measured at fair value through P&L, and the last one is measured at fair value through OCI. Of course, I am not getting into that detail. What are these three types? But for Ind AS 116, for this valuation, you will have to have a amortized cost as your method. Then in Ind AS 109, of course, lessee has to give a security deposit to lessor at the time of entering into a lease agreement. So Ind AS 109 talks about unwinding of that security deposit. So in pre-Ind AS 116, some part of the security deposit will have to be depreciated over the period of lease term, which is mandatory by Ind AS 109. But that we used to call it as prepaid rent. So now that prepaid rent portion will be regarded as property, plant, and equipment only after introduction of Ind AS 116. So how will we subsequently measure this right of use asset and lease liability? So right of use asset will be depreciated over the period of lease term on straight line basis, and that depreciation cost will be part of depreciation and amortization cost. And lease liability will get unwinded every year on the reducing balance method, and interest will get calculated, and interest will form part of my finance cost. So this is what our example is. The rent for the per annum is rupees 10 lakhs. So for the sake of simplicity, I have taken discount rate at 10%, and lease tenure, as I have discussed, is of 5 years. Uh, because of this Ind AS 116, deferred tax calculation will also get impacted. So for that, I have included tax rate as at 30%. So here in this table, I have tabulated lease payments for 5 years and the discounted cash flows at 0th point of time. And the total is rupees 37 lakhs 90,986, which is present value at the start of first year. So with using this value, a right of use asset will be recognized at that much amount and equivalent, which will be equivalent to the lease liability. And this asset will be depreciated over the useful life of 5 years with rupees 7,58,197. So the accounting entry for creating a depreciation is depreciation account debit to accumulated depreciation on the right of use asset. So how the unwinding of lease liability will take place? So this is all about unwinding. So at the 0th point of time for the first year, opening balance will be 37 lakh 90,787. I'll charge 10% interest on that, which is 3 lakh 79,079. Then I'll make a payment of 10 lakhs from that balance. And at the end of first year, my closing balance would be 31 lakh 69,865. So likewise, I'll add interest portion on my opening balance. I'll deduct the payment which I'll be making every year, and I'll arrive at the closing balance. So at the end of fifth year, you can see that the closing balance is becoming nil. So the accounting entries here will be interest expense account debit to lease liability, and lease liability account debit to bank account, the payment entry. So this is what accounting of lease in the books of lessee. But how actually it will have an impact on the financial statements? So this is what this slides will tell you about the impact. So first, if we take a balance sheet, so the companies with operating leases will appear to be more asset rich, but also more heavily indebted. So what do I mean by this statement? If we compare pre-Ind AS balance sheet and post-Ind AS balance sheet, Ind AS 116, in pre-Ind AS 116 balance sheet, the assets and liabilities on the lower side, and in post-Ind AS 116 balance sheet, there is an additional right of use assets and simultaneously a creation of lease liability. So accordingly, your balance sheet size has increased. Then in statement of P&L, lease expense per annum will be replaced by depreciation and interest cost, which will be the outcome of time value of money. So in pre-Ind AS 116 era, companies are charging their rent expenditure on a SLM basis uh, per annum. But now, after introduction of 116, this lease expenditure will be replaced by depreciation and interest cost that we have already seen. So how it will have a favorable impact or adverse impact on the financials? So your EBITDA will be increased and your total assets will have a favorable impact because your total asset side will have a additional right of use asset in your asset bucket. How it will adversely impact on the financials? Your net assets, that is your uh, equity portion, will be on the lower side, or it will get decreased because you will depreciate the right of use asset on SLM basis over the lease period, but you will unwind the lease liability every year on the reducing balance. So because of this reason, your asset side will every year at the end of year, your asset side will be on the lower side, and your liabilities will be on a higher side. So ultimately, your net assets will have a negative impact, and it will have a negative impact on the interest coverage ratios as well. So here I would like to take you to the deferred tax impact on the financials. So in pre-Ind AS 116, companies used to charge rupees 10 lakh per annum. But now in post-Ind AS 116, that 10 lakh will be replaced by 11 lakh 37,276. But in income tax, rupees 10 lakhs is allowable and as deduction and not 11 lakhs 37,000. So there is a net disallowance of 1,37,276 on which company has to create a deferred tax asset of rupees 41,183. Of course, this it will differ from case to case basis, considering its interest rate company is using, or the lease term, or the amount of lease rental every year. So now in our case, there is a deferred tax asset. So here I would like to give you a snapshot of Ind AS 116 and the accounting of it. So if we take for lessor's case first, in lessor's case, if operating lease is there, then you will have to treat it as PP and depreciate it over a lease term that we have already discussed. Then if it is a finance lease, then you will have to treat it as receivable and unwind with the interest income. So the table of unwinding, the balance which was there as a lease liability, that is 37 lakhs, the same balance in case of lessor will appear in their books as a receivable, and lessor will unwind it and recognize a finance income over the period. In case of lessee, if the asset is of low value, or if the lease tenure is, let's say, restricted to the 12 months, then there is an option given to lessee that rent can be charged off to P&L on straight line basis. If that is not the case, you will have to recognize lease liability and recognize right of use asset. So at the time of recognition of right of use asset, if the option is given to purchase it at the end of lease term, you will have to depreciate it over the economic life. Like in our example, in one example which I have discussed earlier, that the economic life of plant and machinery is 5 years, and normal lease term period is, let's say, 4 years. And if lessor is giving me an option to purchase the asset, and if that option is pretty much certain that I'll exercise that option, then I'll simply depreciate it over the period of economic life, that is period of 5 years. But if this such option is not there, then I'll depreciate it over the lease term, that is period of 4 years. Okay, so in Ind AS 116, earlier there was Ind AS 17, and companies used to recognize and used to do the accounting on the basis of that Ind AS 17 of ongoing lease contracts. But while uh, transiting into Ind AS 116, how to account for the ongoing lease contracts? So for that, Appendix C has been given in Ind AS 116. So it gives two methods. One is full retrospective method and the other one is modified retrospective method. So this is for accounting by lessee. So full retrospective method, lessees has to restate their financials uh, of prior periods. So for companies like Reliance, TCS, Infosys, it is not possible practically to restate their financials of 30 years, 40 years, because they are into lease for a period of 50, 60 years. So restating of financials cannot be a good option. Then the second option, which is prescribed by 116, is modified retrospective method. So in modified retrospective method, again there are two separate components. One is recognition of lease liability that we have discussed, and recognize right of use asset. So in recognition of right of use asset, two additional options given by 116. First one is uh, you can recognize the right of use asset equal to the lease liability amount, which we have done in our example. But there is another option which is prescribed by 116 is you let's say uh, companies can calculate the value of right of use asset as if the Ind AS is applied retrospectively. That is at the time of entering into a lease. That is, let's say for example, on 1st April 2012. So the companies can make a lease table from 1st of April 2012 till 31st March 2019, and the difference between the lease liability amount and the depreciated right of use asset till 31st March 19, the difference between these two, along with the deferred tax impact on that, will be adjusted to the other equity balance. So companies can decide uh, based on their asset base, based on how much liabilities they want to show in their books. They can decide what option should be chosen. So at the end of my session, there are certain things to be kept in mind by management as well by the auditor. First one is the disclosure of accounting policies needs to be updated. So in pre-Ind AS 116 era, the lease accounting policies were with the Ind AS 17 literature. So now in post-Ind AS 116, that literature has to be in line with Ind AS 116 literature. Then next one is useful life in PP for ROU asset. So in accounting policies for property, plant and equipment, there is a typical table where classes of assets are given and the useful life of that asset is given. So there, lessees has to add one more line item as leasehold premises, and companies has to mention the period of lease term or the economic life of asset for depreciation. Then companies has to have a separate transition to Ind AS 116 note in the financials. So, which method company has chosen for transiting ongoing contracts into Ind AS 116, whether it is retrospective method or modified retrospective method, or in modified retrospective method, how the right of use asset is created, whether it is equivalent to lease liability or whether it is calculated considering retrospective impact. So that thing has to be mentioned specifically in the annual report. Then last one is COVID-19 impact. So in COVID-19, so currently from 23rd of March till 3rd of May, we are under a lockdown period, which is mandated by our central government. So during this lockdown period, companies can ask their lessor to give certain relaxations for lease, because technically company personnel are not visiting their premises to use that asset or to do everyday work. So they are working remotely. So if such relaxation is given by lessor to lessee, then that has to be factored into our lease working. Next one is companies like TCS, Infosys. They're working remotely in lockdown period in very efficient manner. So they may think in future to cut down their lease cost, uh, which is there as of now. So if they're thinking to cut down such costs, that thing has to be factored into our lease work. And of course, last thing is interest rate, because RBI is changing repo and reverse repo rate to boost our economy. So it will have an impact on the interest rate which I'll be using. So that has to be kept in mind by companies while calculating this Ind AS 116 lease working. Then by the auditor, what things has to be kept in mind? First one is the auditor has to ensure completeness in terms of coverage of all lease engagement. So it is a typical assertion which is given or which is prescribed by standards on auditing. So whether all lease agreements have been covered by lessee, so that auditor has to keenly watch. Then auditor should read all the lease agreements in detail to identify any peculiar clause which will change the entire scenario of accounting. So by form, any particular agreement may look like a finance lease, but any particular clause in it can can because of that clause it can be regarded as a operating lease also. So that this thing has to be kept in mind. Then since the working is done once in for all, so auditor has to check the accuracy of working, because this working will be used in future periods, next years for accounting of leases. So this is all about Ind AS 116. So if anyone is having few questions, you can put in chat box. I can answer it one by one. Okay, so there is a question uh, from Swarada. Uh, what is accounting treatment for cancellation of lease contracts? So for cancellation of lease contracts, let's say for in our example, if the lease period is of 5 years and after 3 years, X Limited is willing to cancel the agreement, then the balance which is there of right of use asset and the lease liability, X Limited has to net it off, and the remaining amount X Limited has to charge it off to P&L. So that is the treatment. Okay, so next question is, can we remeasure the liability for the changes in discount rate? Uh, Primarily, there is no such thing is prescribed. But if the discount rate is getting factored because of this COVID-19 impact, and it will be for a longer period, then there is a possibility that you may have to remeasure your lease liability. Okay, so as on 31st March, acha, so I think I have answered for to Aniruddha for his question. So yeah, I would like to hand it over to Omkar.
Thank you very much, Kunal. I
Yeah,
think there is a time we can wait for the questions also
yeah,
for few minutes,
definitely.
because there may be some people who are maybe writing right now. So we'll
Oh, okay.
couple of minutes, and if there is no response, we can head we
And
can
of
move.
course, I have mentioned my email ID also over there in my and our scrolling line with there is my email ID. So you can connect me personally if anything, if anyone is having certain issues for Ind AS 116 accounting.
I think Kunal has already mentioned. Yes, Aniruddha had also thanked for your answer, Kunal. And as Kunal mentioned, we have the email ID mentioned. No, it has not been mentioned. Can we mention it right now?
Yeah, it is there in a scrolling line, and
Okay.
I've also highlighted in my PPT, like last slide of my PPT. So
Okay.
if
So
anyone is
what?
interested in sorry, just if anyone is interested in discussing Ind AS 116 in detail, you can do let me please connect using my email ID.
Yeah, yeah, sure, Kunal. So this was really a nice session that it has got many technical intricacies involved in this 116 about leases and about the lease transactions and the treatment books. It was very utterly explained by CA Kunal, and there are some points which are to be kept in mind as highlighted by CA Kunal, COVID-19 impact and what things that are to be checked by auditor also. So this was really a value addition in knowledge point of view and overall the updating point of view. So thank you very much, Kunal. And
Thank you. Thanks a lot.
I really thank from the bottom of heart that you waited for last I think for an hour, and
with Omkar. So thank you, Kunal, for your insightful session. Tomorrow we'll be having a management talk, which will be conducted by CA Gaurav Survey sir. He's a very active person in the professional field and will be surely eager to hear him about tomorrow. So let's meet tomorrow. Let's keep learning. Be safe. Stay safe with your family and everyone during these difficult times. Thank you.